Rad Accounting Tutorials. So today we have a question on production costing techniques. One question on production costing techniques. That is what we are going to solve a week. So we have this question.
The data below relates to Wiseman Company Limited, which makes and sells one product, where we have 2 months, where is March and April. The production unit for March is 8,000 and for April is 2,000. And the sales unit is what? 4,000 and April is what? 6,000. We have the selling price per unit, which is 8 for each month. Variable production cost per unit for each month is 4. And the fixed production overhead incurred is 9,600. And he said what? Being the predetermined recovery rate is what? 1.2. Take note of that. The predetermined recovery rate is 1.2 for each month. And he said we have the selling and distribution costs. Fixed is 4,000 and the variable per unit is 0.5. The requirement says you are required to present a comparative profit statement for each month using the variable costing, the absorption costing, then you would, the last is for you to reconcile the profit or loss of the two methods.
First of all, when you have this question, the first thing that you have to do is so let's find cost per unit for the variable, the MC. So the question, when you look at it, we have the variable production cost per unit to be 4. We have the variable cost, and we have our fixed cost. So when you read the question says, being the predetermined recovery rate is what? 1.2 Ghana cedis, meaning that is the amount that they are going to use to recover the fixed cost. So that means that the fixed cost per unit, that is the amount fixed cost per unit, being the predetermined recovery rate, that is the fixed cost per unit. You get it? So, but then under the marginal costing deals with only the variable cost, which means fixed cost the variable to our production cost per unit to be 4. So now when you have this, now you can start with your work. So now let's start with the variable costing. Let's start with the variable costing. So income statement. Using the variable. So if your income statement, as we already know, we always start our sales. So our sales, what is our sales? When you look at the question, find our sales units and multiply it by our selling price per unit. So our sales units for March, sorry, sales units for March. It is March and April. So March. So our sales unit for March is 4,000. The selling price per unit is 8. So 4,000 by 8 will give us 32,000. Now we less our costs. So less our cost, we find our marginal cost of production. Find our marginal cost of production. So we find our production units. What's our production unit for March? Production unit for March is 8,000. And under the marginal costing, the production cost per unit is what? 4. So we are going to multiply the 8,000 units by 4, which will also give us 32,000. So now the next thing that we are going to do is to find our closing units. The next thing that we are going to do is to find our closing unit. So the Wise company produced in the month of March, they produced 8,000 units and they were able to sell only 4,000. So for us to get our closing units, we need to be 8,000 minus the 4,000. And now we have our closing units to be 4,000 by what the production cost per unit. Now to realize this, another marginal costing or variable costing resources. So in the question, we have our variable expenses, we have our selling and distribution costs, where our variable cost per unit is 0.5. So we selling and distribution cost will be on the sales unit. The variable selling and distribution cost will be on the sales unit. So they are saying for every unit, the selling and distribution cost is 0.5. So we sold 4,000 watt units, which means we are going to multiply the variable give us 0.5 by the unit sold, which is 4,000, which is equal to 2,000. So we are going to add to the cost of sales. That's when it comes to the variable costing. You need to add your variable expenses to your cost of sales. So 16,000 plus 2,000 give us 18,000. So now we less this from our sales. So when we less this from us, when we less 18,000 from 32,000, we are going to get 14,000. And 14,000 will be our contribution. We all know that sales minus contribution. So after we have our contribution, the next thing that we do is to less our fixed costs. Less what? Fixed costs. Because the sum of both fixed production cost and our fixed expenses. Fixed production costs and our fixed expenses. And in the question, we have our fixed expenses to be our fixed production overhead is 9,000. So fixed production 600. And our fixed selling and distribution costs is also 4,000. Plus 4,000 is going to give us 14,000 minus 13,000. 600 will give us 400 for the variable costs. Now let's move on to the marginal costing for February. So income statements. Costing. Yeah. So as usual, we start with our sales. So in the month of April, we check 6,000 units and the selling price per unit by 8 give us cost of sales. First of all, what you have to check is when you check March, there was a closing unit of what? 4,000. So what you have to know is the closing unit of March will be the opening unit of what? April. So when you come to March, we have opening what? Inventory there. We have opening inventory, which is 4,000 times 4. So we're going to have 16,000. Then now we come to the production for April. So in the month of April, 2,000 units was produced. So another variable costing, the production cost per unit is 4. You multiply by 4, gets 8,000. 8,000. So 16,000 plus 8,000 will give us 24,000. That is the cost of goods available for sale. Then what you find out closing stock. So when you check this one, the sales unit was what, 6,000. So in the month of April, we had 4,000 plus 2,000 units to sell. It is 6,000. Meaning all the 6,000 was sold. Meaning we don't have any closing. We don't have any closing units. So this will be our cost of sales. This will be our cost of sales. So another marginal costing. You get your cost of sales, then you add variable expenses. The variable expenses we have there is variable selling and what? Distribution, which is 0.5 per unit. So in the month of April, we sold 6,000 units, which means 0.5 times 3,000 times 6,000, sorry, which will give us 3,000. So 24,000 plus 3,000 will give us 27,000. We are less. So 48,000 minus 27,000 will give us 21,000, which is our contribution. So when you have your contribution, you less your fixed costs. Less your fixed cost. Our fixed cost, we have our fixed production, which is 9,600. And we have our fixed selling and distribution, which is 4,000. So 9,600 plus 4,000 will give us 13,600. So 21,000 less than 13,600 will give us 7,400, which is our net profits. Very well. So now let's move to absorption costing. Now let's move to the absorption costing. So let's move to the absorption costing. So when it comes to the absorption costing, I want to explain something here. So you see, they've given you the being the predetermined recovery rate to be 1.2, which means you have a number of units that you need to produce. You have a number of units that you need to produce. That is the normal capacity. Since they're giving the predetermined recovery rate, and it means there is a normal capacity that you have to produce. So if you are not able to produce exactly that unit, then it's either going to be under absorption or over absorption. There is under absorption or over absorption only under the absorption costing. There is no under absorption or over absorption under the absorption, under the marginal costing. Under absorption and over absorption only comes under the absorption costing. So in this question, you can see that you are not given the normal capacity in the question, but then you've been given the predetermined recovery rate. So we are going to use the predetermined recovery rate to find the normal capacity. How do we find that? So we say that the normal capacity, let me write absorption. So let's see that around the absorption. So the normal capacity, let's write NC, is equal to 9,000, which is the production overhead. That's the fixed cost. Production overhead divided by 8,000 units, which will give us 8,000. So some of the questions will give you the normal capacity to be 8,000, 10,000. Yes, if they give it to you, that's fine. But indeed, the question gives you the predetermined recovery rate. Then you're going to divide the fixed cost, that's the fixed production cost, by the predetermined recovery rate. And you're going to get the normal capacity. So it means you are supposed to produce 8,000 units. So if you produce more than the 8,000 units, then there is over absorption. If you produce lesser than the 8,000 units, then there is under absorption. So that is how we go about the absorption costing. So let's start the absorption costing for January. So here we have income statement using absorption costing for the month of January. So we have our two CD signs here. So we start. So under the absorption costing, our production cost per unit was 5.2. That's the variable cost per unit, which is 4, and the fixed cost per unit, which is 1.2. So when we add these two, it is 5.2. So under the absorption 5.2. So let's find our sales first. So our sales, the month of March, not January. I don't know why I keep on saying January. The month of March, the sales unit for March is 4,000. So 4,000, the selling price per unit is 8. So we have the same thing here to be 32,000. 32,000. So we less costs sales. So our AC of production. So in the month of March, we produced 8,000 units. The production cost per unit is 5.2. So 8,000 by 5.2 will give us 41,600. Then we check. We produced 8,000, but then we were able to sell only 4,000. So it means we have a closing unit of 4,000 units. So 4,000 by 5.2 will give us 20,800. So we are going to less this. When we less this, since it is half, then we're supposed to get 20,000. So that is the cost of sales. So when you get to the cost of sales, you check whether there is under absorption or over absorption. So we are supposed to produce 8,000 units. We're supposed to produce 8,000 units. And in the month of March, we produce exactly 8,000 units. So it means there is no under or over absorption since we produced exactly 8,000 units. So we less the cost of sales from this, when you less cost of sales from this, then we have our gross profits. So 32,000 minus 20,800 give us a gross profit of 11,000. So at this point, what you do next is to less your non-production costs. So you less non-production costs. Your non-production cost, which has been given to you in the question, is the fixed selling and distribution, and the variable selling and distribution. So fixed selling and distribution, which is 4,000, and the variable selling, which is 0.5, by the sales unit, which is 4,000, will give us 2,000. So 4,000 plus 2,000 will give us 6,000. So since here we've written less, so 11,200 minus 6,000 will give us 5,000, which is our net profit under the absorption costing for March. Okay, so now let's move to the absorption costing for April using so we have our two C signs. We find our sales during the month of April. We sold 6,000 units by 8, which is 48,000. Less our cost of sales. So as I said, for the month of March, there was a closing inventory. There was a closing inventory here. So the closing inventory for March will be the opening inventory for April. So here we're going to have opening inventory. Opening inventory is 4,000 by 5.2, which will give us 20,800. So now we move to the production itself, AC of production. That's the absorption costing of production. So in the month of April, produced only 2,000 units. Produced only 2,000 units, which will give us 10,000. So when we add these two, we are going to have 31,000. That would be cost of goods available. So here, when we check this one, we had 6,000 cost of goods available to sell is 6,000 units, and we sold 6,000. So it means there was no closing units. So here you check. This is where you need to check the under and over absorption. So when you look at the question, as I said, the normal capacity is what, 8,000. So it means for every month you're supposed to produce 8,000 units. But this is the case in the month of April. We produced only 2,000 units. Produced only 2,000 units. We produced only 2,000 units. It means we produced lesser than what, 8,000. And the difference between the 8,000 and 2,000 is what? 6,000. Is what, 6,000. So it means it is under absorption. And if it is under absorption, you add back. If it is over absorption, less. So since this they produce lesser than the normal capacity, which is 8,000, you have to less. So you find the difference between the normal capacity, which is the 8,000, which they are supposed to produce, and what was exactly produced. So 8,000 minus 2,000 will give us 6,000. So we multiply this 6,000 by the fixed component, by the fixed cost per unit. So that is it's the fixed cost that has been under absorbed. So we multiply the 6,000 units by the fixed cost per unit and the fixed component. The fixed cost per unit is what? 1.2. So 6,000 by 1.2 will give us 7,200. So since it is under absorption, then we are adding. So 31,200 plus 7,200 will give us 38,000. So we are going to less this, get our gross profit. So 48,000 minus 38,100. We are going to have 9,600. So when you get your gross profits, we less non-production non-production. So what is our non-production cost? What is our non-production cost in the question? Our non-production cost in the question is the fixed selling and distribution and the variable selling and distribution. So our fixed selling selling and distribution is 4,000. The variable selling is 0.5 by 6,000. Just 3,000. So when we add this, we're going to have 7,000. So 9,600 minus 7,000 will give us 2,600. So that's the net profits for April using the absorption constant. And now they are saying we should reconciliation. So let's check if what we've done is really correct by reconciling. So if we reconcile and it's correct, so with the reconciliation of profits, when you start with the profits as per marginal profits, the profit as the marginal costing, what you do is you add the closing fixtures, the opening fixed component. So let's start with the profits. As per marginal. So our profits as per marginal costing for the month of January. So let's do the reconciliation for January first. Sorry, why do I keep on saying January? March rather, sorry. Because January just ended, we are in February. Okay, so for March. So our profits as per marginal costing for March is 400. Then we add the closing fixed component. So what's the closing fixed component is just trying to say is find the closing units in March and you multiply by the fixed component. That's the fixed cost per unit. So our closing units in March, the marginal costing is what? 4,000 units. So we multiply 4,000 by 1.2 will give us 4,800. And there was no closing units. So if there were no opening units. So if there were to be opening units, then we are going to less opening fixed components of it. So since there was no opening, then it means the opening will be what? 0. So we are just going to add this 4,000 by this, then we are going to get 5,200. So this must be the same as the profits as per what? The absorption costing for the month of March. Let's reconcile the profits of April. Let's reconcile the profit of April. So reconciliation of profits for April. The profits as per marginal costing for April. Profits as per marginal costing for April is 7,400. So what we do is we add the closing fixed components. Closing fixed components. So in the month of April. The closing, was there any closing? There was no closing. So what we do is we will less. That will be zero. There was no closing in the month of April. That will be dash. Then we less the opening fixed components. So in the month of April, there was opening units of 4,000. There was an opening unit of what? 4,000. So the opening unit is what? 4,000. So multiply this cost per unit. So 4,000 by 1.2, which will give us 4,800. So 7,400 minus 4,800 will give us 2,600. So we reconciled our profits. So 7,400, zero, there's no plus unit, so this is zero, minus the opening fixed component, which is 4,800. So this one is the profits. So that is it. We are done with the question we solved. Thank you for watching my video. I encourage you to subscribe to my channel. I'll be bringing more content questions for you. So please subscribe to my channel and share for others to also have the benefits of this channel. Bye bye. See you in my next